Bank of America Chair and CEO Brian Moynihan joins us here first on CNBC to break down the quarter. Welcome back, Brian. Nice to have you.
It's good to be here, Sarah. Good to see you.
So to what degree does Bank of America get hurt by lower rates if you do expect net interest income to continue to rise?
It's a complex question, but we disclose our sensitivity beyond the curve. But given the curve that we see, the one in the market, we don't make it up. We take the market's curve. We see growth in NII next for the fourth quarter and beyond. And so we feel good. It's a very complex thing because you have fixed rate assets which don't get hurt so much. We have non-interest-bearing deposits which squeeze a little bit. You reduce the rates on interest-bearing deposits. Commercial loans come down, but some are hedged out to longer periods of time. But in the end of the day, we disclose all that. But you put it all together, and NII is growing, which is the important thing. And the important thing is deposits and loans are growing for 5 straight quarters of deposit growth, and loans grew, especially in the latter part of the quarter. We had a nice pickup.
Right, because that's been sluggish overall. Where do you expect loans to continue to grow?
Well, the loans in the commercial side have been sluggish largely because the rapid rate increase really affects small businesses and middle market companies who use lines of credit, our floating rate above an index, and that index went up over the last 24 to 36 months by 500 basis points. And so it came down a little bit at the tail end of last quarter, and we'll see that come through. But the line usage, which is their use of those lines, is at a much lower rate than it was pre-pandemic or in normal times, let's just call it that. And that's because companies have to be careful because the cost of borrowing went up. That's the restrictiveness of where the rate structure is now. The real rate structure affects consumers some, but really affects small businesses and mid-market businesses much more.
So given all of that and all of these investor questions around the rate outlook, Brian, what rate environment would be best for Bank of America?
At the end of the day, our job is to make money and grow the company in any rate environment. But what we believe in the company, our research team, led by Candace Browning-Platt, and the team does a great job. They believe there's 2 more cuts this year, and we end up with a terminal rate about 3% at the end of next year. And that's the important thing, whether there's a cut this quarter or next quarter or 50 or 25. And there's just a lot of work going on, and we got a lot of people who analyze that a lot. But the reality is, where's it going to end up? And if it ends up with a terminal rate of 2.75 or 3 and 3 1/4, depending on which expert you look at, that is a wholly different environment than we've been at since 2008. And so that difference is really the strength of the U.S. economy, the fact that the innovation and capitalism that goes on in this country drives through and allows a higher rate structure to finally be there with inflation being in control, and you're seeing inflation come down. That would be a good thing for the U.S. and, frankly, a good thing for the world.
Were you surprised they kicked it off with a double rate cut, going 50?
I think everybody's a little surprised, but I think the data at that time showed that the slowdown was occurring. The Fed's risk is obviously more to the downside now that they are too restrictive for too long, and that then cuts off the economy. And right now, as we saw the consumer activity in our client base in the third quarter and then in the month of October so far, it is more consistent with a 2% growing economy and a low inflation economy growing at 4.5% nominally a year. That's a good place. It had softened a little bit in the summer, in July, and even into August, where I was getting worried that we were down at 3.5, and that number could indicate that the consumers are giving up. And so the good news is the consumers keep spending, albeit different stuff at every quarter is a little different. But overall, the amount of money they're moving in from our customer base, 60 million plus American consumers, moving well over $1 trillion in the economy every quarter. It grew at 4.5% last quarter, third quarter over last year's third quarter, and is still growing at that rate. That means the consumer is still in the game and spending, which fuels an economy that's stable. But we have to be careful that we don't choke it off, and that's where the higher interest rate impacts on car borrowings and other things affect them.